You're talking about the potential for a 10% correction coming through for the US. What would that mean for perhaps, let's start with Asia. Can we expect particularly these EM markets to see an even more significant correction than that?
Not necessarily. And so I think what you'll see is an expectation, again, similar to last year where we started to see a drawdown in markets. What we saw last year and what we expect to see this year, and frankly what we're hearing from the investor base that I talk to relatively frequently, is this rotation out of outperformers and into lower valuation, less is priced in type of storylines. And so one of the reasons why I think you're seeing the strength that you're seeing across some of the China markets today is not that the macroeconomic picture is any rosier than we thought. Yes, first quarter GDP surprised on the upside at 7.4%. But if you look at nominal GDP, it actually missed because of inflationary expectations, right? But it's looking through the stack and saying if you are investing in line with the strategic priorities of the government, those are likely to make a good degree of sense, and they're at rock bottom valuations today. And so risk-proofing the portfolio by rotating out of expensive winners into more defensively positioned stocks makes a lot of sense.
Just let's start talking about China a little bit more than what we just did. You mentioned the fact, you were talking about the GDP, and we did see, in that Q1, the deflator was minus 1.1, and we saw that March trio data seeing a little bit weak at the same time. But does that necessarily exclude the notion that people should be investing in China equity markets right now?
It's a great question. And I think particularly for China, we have to bifurcate between the macroeconomic conversation and the equity market conversation. As we've spoken in prior conversations, I hate the index. I don't hate the index, but I hate the concept of the index, right? Because it's not indicative of the state of the underlying economy. It's not indicative of the companies which our investors have access to for incremental positive returns. And our argument from a JPMorgan perspective is bottoms-up idiosyncratic company research, what my team does for a living, not shocking, is absolutely critical. Let's talk about my book a little bit. But sort of the top-down, what is the index doing? I don't care. What I care about are some of the great bottoms-up good companies that we have access to at rock-bottom valuations. The overlay to that gets a little bit more interesting from the perspective, again, we want to continue to focus on industry segments that the government has identified as strategic. And again, the delinkage from the macro. The problem with that conversation is that they're primarily export-driven, scaled type industries, as you discussed earlier, EVs, et cetera. The problem with that is it's deflationary, right? And so at some stage, the Chinese government has an absolute macroeconomic requirement, as they've discussed for years, to shift growth towards domestic consumption. Retail sales just fell 1.5%. Yeah. That's not occurring today, right? It also, frankly, shields China from global intervention from the perspective is that they're not so entirely dependent on the export impetus. And so it's a defensive move for China to move to a more consumer-driven economy. We're not seeing that pivot successfully occur yet.
And I suppose to that effect, if we're talking, just strictly about EVs, they're caught up into this, this geopolitical maelstrom at the same time, whether it be, in terms of the EU and the dumping, that's one thing entirely. Yeah. But there seems to be this growing consensus in the United States, whether it be, Senator Sherrod Brown saying there should be a full ban, or whether it be, different legislators calling for tariffs. How consequential will that be to the China EV space, if at all? Because you mentioned the domestic ability to circle that demand at the same time.
Yeah. So two components to the answer. One, the China model is to pick a number of key industries in which China will become globally competitive, ultimately through economies of scale. That's been true in lots of different industries, from solar to EVs, et cetera. And we're absolutely seeing it in the EV space right now. China currently has manufacturing capacity for both internal combustion engines as well as for EV vehicles, significantly in excess of what the domestic market can bear. So again, they are absolutely reliant on exports to continue to employ these citizens and continue to push that GDP number. That is an issue if you start to take significant sections of the global economy off the table. Can China replace sales to certain countries with sales to other countries? Remains to be seen. And so it's an important question. The second part of the conversation is, again, redefining some of these industries. Are we talking about cars, or are we talking about a consumer electronic device? Both.
Yeah.
And that drives a significantly different set of concerns than just an automobile.